All right, buckle up, because this week the markets, well, they threw us a curveball after curveball, yet somehow we're ending in the green pretty much across the board.
It was quite something.
Globally, we saw this powerful rebound. It seemed fueled by a mix of things, really. Renewed hope around trade talks.
That was a big factor.
Some absolutely stellar earnings, especially from the tech giants, and maybe even some hints from policymakers about potential easing later on.
Whispers, perhaps. Now, it's not all smooth sailing if you dig just a little deeper.
Right.
Those familiar worries about slowing growth and, inflation that just won't quit, they're still definitely there.
It really feels like a tale of two worlds. You've got U.S. tech just soaring, almost in its own reality, while Europe is grappling with, well, stagnation really feels like the word, and China's stimulus. It feels more like a gentle nudge than a big push.
And what's fascinating, I think, is peeling back the layers on this global rally. The U.S. surge, particularly big tech, it almost feels like its own separate ecosystem, responding to very specific things.
Exactly.
Whereas the gains we saw in Europe, parts of Asia, they seemed more broadly tied to that whole easing of trade tensions narrative.
Yeah.
It just shows how markets can move together on a headline, but their underlying drivers are often quite different.
Okay, so let's dive into that engine room, starting with the powerhouse. The U.S. markets. The S&P 500 put on a strong 4.6%.
Pretty solid.
The NASDAQ, it just bolted ahead, up 6.7%. And even the Dow managed a respectable, 2.5%?
Yeah.
Really felt like tech just showed everyone how it's done this week.
Oh, absolutely. That near 8% jump in the S&P 500 tech sector, that's the headline number, really. Those earnings reports weren't just good, some were absolute knockouts, huge enthusiasm boost.
Huge.
But, and there's always a but, isn't there? If we connect this amazing tech performance to the broader economy, well, that excitement might be masking some softer data underneath.
How so? What are you seeing there?
Well, while tech was popping champagne corks, metaphorically speaking, the S&P Global Flash PMI, that early read on economic activity.
Yeah, the PMI.
It actually dipped quite noticeably, hit a 16-month low. And the main reason was a sharp slowdown in services activity. And services, as we know, that's a huge part of the U.S. economy.
So the companies powering our digital lives are thriving, great earnings, but the more sort of traditional service side of things is feeling the pinch.
Seems that way. And it wasn't just businesses feeling a bit less chipper, was it? That University of Michigan Sentiment Index.
Ah, yes, consumer sentiment.
It slid again. 4th month in a row now.
4th month. And what are people citing? Still inflation? Trade?
Exactly the same things. Lingering worries about inflation, costs, and that ongoing uncertainty around global trade. So you've got consumers feeling increasingly uneasy. Even while the stock market, led by tech, seems pretty happy, it does make you ask, can this tech momentum keep going if the wider economy starts to, sputter a bit?
Yeah, that's the key question. So the big takeaway from the U.S. tech strength, lifting the indices, absolutely, but look beneath the surface. And the broader economic engine seems to be losing some steam. Okay, let's hop across the Atlantic. The Eurozone, they also saw positive moves, right? StoXX, Europe 600, up around 2.77%.
Yep.
And the DAX in Germany, CAC 40 in France, even stronger rallies. FTSE 100 in the UK ticked up too. Was this just riding the coattails of that trade optimism?
That initial boost, yeah, seems like the common factor. But the underlying economic story in the Eurozone feels a lot more fragile, I'd say.
Fragile how?
Well, we have to talk about Germany's revised GDP forecast for 2025. They slashed it sharply, down to 0 growth.
0. Wow, for Germany.
0. And the German authorities are pointing fingers directly at the impact of tariff shocks as a primary reason.
0 growth for the economic engine of Europe.
Yeah, it is.
That's a really concerning signal. How's the ECB, the European Central Bank, taking all this?
Well, their chief economist, Philip Lane, he's trying to walk a fine line. He said they don't see an imminent recession, which is, somewhat reassuring.
Okay.
But he also gave a clear warning about increasing risks to growth. That kind of careful language tells you a lot about the concerns they have internally.
It certainly does. And it's not just forecasts, is it? The actual business activity data, the PMI again, not looking great either.
Not great at all. The Eurozone PMI slipped to 50.1. That's barely above the line, separating expansion from contraction.
It's clinging on.
Exactly. So yes, the markets had a bit of a relief rally, but the fundamental data really highlights these growing headwinds for Europe. And Germany's situation is particularly worrying given how much they rely on exports.
Right.
Those market gains could easily fade if the economic reality keeps getting tougher.
Okay, so a more precarious picture in Europe. Let's quickly pivot to the UK then. FTSE 100 up, what, 1.69%? Modest gain. But there was some surprisingly good news on the retail side.
Correct. That 0.4% month-on-month jump in retail sales for March, that was unexpected, definitely beat forecasts. It suggests that UK consumers are still managing to spend.
Which is interesting because you contrast that with the GfK consumer sentiment data. That showed confidence weakening again, right?
It did. And that divergence really shows the complexity in the UK right now. People are still spending maybe out of necessity, maybe specific things. But those underlying anxieties about energy bills, cost of living, they're clearly weighing on the overall mood. It makes you wonder how long that retail resilience can last if cost pressures don't ease up.
So mixed signals from the UK, spending's happening, but caution is definitely in the air. Okay, let's head east to Japan. Markets there also saw gains. Nikkei 225, 2px, both up around 2.7, 2.8%.
Yep, riding that global trade relief wave again.
Seems like it. But Japan has its own specific challenges, doesn't it? Particularly inflation starting to bubble up.
That's a really crucial point. That jump in Tokyo's core CPI to 3.4% year over year, that's the fastest in 2 years. And it really complicates things for the Bank of Japan and the BOJ. They've been trying this very careful balancing act with their policy.
Right.
And this upward inflation pressure, it adds a whole new layer of difficulty.
Because it might force their hand towards tightening more or faster than they planned.
Precisely. It raises big questions about the timing, the pace of any future policy shifts. Plus, you saw the Japanese government announcing new support for industries hit by U.S. tariffs.
Ah, so the trade impact is still being felt directly there, too.
Oh, yes. So for Japan, it's this story of external market optimism bumping up against rising domestic prices and this tricky monetary policy navigation.
Inflation definitely throws a wrench in the works for central banks. Okay, finally, let's look at China. Markets there saw more modest gains, didn't they? Shanghai Composite, CSI 300 up slightly. Hong Kong's Hang Seng did a bit better, up 2.8%.
Yeah, more muted gains on the mainland.
And the main story there seems to be anticipation, waiting for more stimulus.
That's definitely the dominant feeling. The Politburo made pledges, talked about emergency plans, boosting financing for key sectors. That gave investors some hope.
Okay.
But we haven't really seen the big concrete stimulus actions that maybe some were expecting or hoping for. Not yet, anyway.
And the shadow of those U.S. tariffs is still looming large. Analysts are still warning about the economic drag.
Absolutely. The potential drag from those tariffs could become more obvious soon. So, yeah, there's optimism in China based on potential policy support. But the actual delivery and those lingering trade effects, they create significant uncertainty. It feels a bit like a market in a holding pattern, just waiting for a more decisive move.
Okay, got it. So that's the global wrap. A really fascinating mix, optimism in pockets, especially tech, but these underlying worries about growth and inflation just aren't going away. Now let's look ahead. The coming week, April 28th to May 2nd, looks absolutely jammed with key economic data. Crucial stuff. Starting with the U.S., what should we be laser focused on?
Oh, the U.S. calendar is packed. Tuesday, you've got JOLTS job openings that gives a sense of labor market tightness.
Right.
Plus Case-Shiller home prices and the Conference Board's consumer confidence read. But really, the middle of the week is where the big ones land. Wednesday, the first look at Q1 GDP, huge.
A big growth number.
And the ADP private payrolls report. Then Thursday's inflation day, the PCE price index. That's the Fed's preferred measure, so very important.
Crucial for the Fed.
Plus ISM manufacturing PMI, pending home sales. And then Friday, the grand finale, the official non-farm payrolls report and unemployment rate for April.
The jobs report, always massive.
Massive. It could seriously shift thinking on Fed policy. Oh, and factory orders, too, on Friday. That jobs report, though, that's the one everyone will be watching.
Absolutely. A flood of U.S. data. What about Europe? What are the key things to watch there?
Europe starts with the final Eurozone consumer confidence for April on Tuesday. Wednesday is the big day there, too. Preliminary Q1 Eurozone GDP.
First glimpse of growth, or lack thereof.
Exactly. And the flash April inflation reading, the CPI, super important for the ECB, especially with their June meeting coming up. Keep in mind, Thursday is Labor Day, May 1st. So many European markets are closed.
Good point. Holiday impact.
Then Friday, we get UK nationwide house prices for April and German retail sales for March. That German retail number will be interesting, see if it confirms any consumer weakness.
Right. Keeping an eye on the European consumer. And Japan, what's on their docket?
Japan's week starts slow, show-a-day holiday on Tuesday, so Tokyo markets are closed.
Okay.
Things ramp up Wednesday. Preliminary industrial production for March that tells us about manufacturing strength.
Important for exports.
And retail sales for March, too. Thursday, we get the summary from the BOJ's last policy meeting, should offer some clues on their thinking.
Policy insights.
And Friday, Japan's unemployment rate for March and the Consumer Confidence Index for April. That industrial production number, though, that's probably the key one to watch for Japan this week. See how manufacturing is holding up.
Got it. Important indicators there. And finally, China. Key data points for them.
China's data is front-loaded. Tuesday, the official manufacturing and non-manufacturing PMIs for April. These are big because they're the first major read on activity after those new tariffs kicked in.
First post-tariff signal.
Crucial, very crucial. Then Wednesday, the cakes and manufacturing PMI, which focuses more on smaller private firms. Like Europe, China's markets are closed Thursday for Labor Day.
Okay.
They reopen Friday, but maybe lighter trading. Those PMIs early in the week, absolutely critical for gauging the initial tariff impact.
Okay, so a week just brimming with potentially market-moving data everywhere you look. Let's try and crystallize this. What are the absolute highlights, the things that could really shake things up?
Yeah, if I had to pick the biggest potential movers, for the U.S., definitely Q1 GDP and that PCE inflation number. They're going to feed directly into the Fed rate cut debate.
Huge for Fed expectations.
In the Eurozone, it's also GDP and inflation Q1 GDP and the flash CPI. Those will massively influence the odds of that ECB policy pivot in June everyone's talking about.
Right, ECB's June move.
For Japan, I'd say watch that industrial production number closely. It's key for gauging external demand strength. And China. All eyes on those PMIs for the first real post-tariff signal on factory activity.
Okay, crystal clear. Those are the potential flashpoints. Now, thinking about the week ahead, what would you flag as the top, say, 5 key risks investors should have on their radar?
Good question. I think the top 5 risks are really tied to potential surprises in that data we just talked about. First, a U.S. growth surprise or disappointment. That Q1 GDP number on Wednesday, if it's much weaker than expected, it could ignite slowdown fears much stronger. Maybe that fuels Fed tightening worries again.
Two-sided risk there. Okay, what's second?
Second, sticky U.S. inflation. If that PCE report on Thursday comes in hot, showing persistent price pressures, well, that could really pour cold water on hopes for rate cuts anytime soon.
Pricing out the cuts. Got it. Third,
Eurozone recession fears intensify. Imagine a scenario where Q1 GDP shows contraction and inflation stays stubbornly high. That's a nightmare for the ECB and probably bad news for European stocks.
difficult policy mix. Okay, fourth risk.
Fourth, China growth signals falter. If those PMIs, especially post-tariffs, come in really weak, that could easily fuel broader pessimism about global growth prospects.
Global contagion risk. And number 5.
And finally, number 5, Japan's fragile recovery exposed. If their industrial production or consumer data disappoints, it could shake confidence in their recent recovery narrative and really complicate the BOJ's path towards eventual tightening.
Right. Makes their job even harder. So it really comes back to this delicate balance, doesn't it? Juggling fears about slowing growth against this problem of persistent inflation. This week's data dump could really tip the scales one way or the other.
Precisely. That's the core tension right now, growth versus inflation. And the incoming data will either reinforce the current market narratives or seriously challenge them. That dynamic is what's likely to drive sentiment and probably volatility in the coming days.
And there you have it, a week absolutely loaded with potential market-moving information. Make sure you're keeping a close watch on those key data releases we discussed. Remember, this deep dive, it's really just the starting point for your own understanding. Maybe you want to dig into the details of those Chinese PMI reports, or perhaps dissect the different parts of the U.S. GDP number when it lands. Understanding these fundamental forces is just so crucial, not only for any investment decisions you might make, but really for grasping the bigger shifts shaping our global economy right now. Thanks for taking this deep dive with us.